Niveen with Chino Hills Beachside, and welcome to another episode of Chino Hills Fridays. Today, I'm meeting with one of the essential team members of Chino Hills Beachside, Jerry Ruiz, who is with New American Funding, and important questions that he will answer, so stick around. Don't forget to like this video, share it with others, and subscribe to my channel. Jerry, thank you so much for meeting with me today. So can you please introduce yourself and tell us how long you've been in the business?
Hi everybody, I'm Jerry Ruiz. I work here at New American Funding, and I've been in the business for over 18 years.
Wonderful, great. So you are a wealth of experience right
Yes.
here. So Jerry, tell us, what are the options for first-time home buyers? What are the lending options or loans that they can get?
Okay, there's a lot of different options for first-time buyers that they may not be aware of. The first option is they come in with their own money, all right? They've saved money from college, from their job and their bonuses. And for the first-time buyer bringing in their own money, there's the FHA program, which allows them to put down a minimum of 3.5%. They want to go with the conventional loan, they put down anywhere from 3%, 5, 10, 15, 20% down. The other part where individuals have not had the ability to save money but have a great credit score and they have a good job, we do have state programs. The state program requires a minimum of 640 FICO score, your credit score. And what they do is they give you up to 7 to 8% to be used for the down payment and the closing costs. The state charges 1.5%. So most of the scenarios that we see out there, the client comes in out of their own pocket anywhere from $0 to about $2,000 at the most, Niveen. The other part is we have veterans out there. We have a VA loan, which is the best loan out there available to people. On a VA loan, you don't put any money down, all right? And they have the best interest rates. And the best thing about that program is there's 3 components to that loan. There's the principal and interest payment, there's the homeowner's insurance, and there's the property taxes on that loan. Whereas on the FHA loan, if you put down 3.5% down, you have 4 components. You have the principal and interest, you have the property taxes, you have the homeowner's fire insurance, and you have PMI, which is private mortgage insurance that protects the investor from you defaulting on that loan. So like the conventional loan and the FHA loan, you have PMI, and PMI on a conventional loan, we recommend it when you have a very strong credit score from 680 to 700 and above. And the reason we do that is because the PMI on a conventional loan can be removed after 2 years and you have 78% loan to value, and you haven't had any late payments. Whereas PMI on an FHA loan is it stays on for the length of the loan.
Wow, that's great information to know for first-time home buyers, so they can decide, of course, and once they connect with somebody like Jerry, then they will be able to exactly tell them where to go and which loan is perfect for them. Now,
But I want to add one more thing.
Sure.
I forgot, Niveen, on that. The other scenario that we see quite often is family members gift the buyer money. A lot of times people don't realize they can gift, their parents can give them.
A family member.
Right, a family member has to be a family member, can't be a friend. Unfortunately, they changed those rules. A family member can gift them money anywhere from 1,000 to 20, 30, 40, 50 to 100,000. We've seen a lot of different scenarios where the family members gift the first-time buyer money.
And that helps with the
closing costs and down
closing
payments,
costs
and getting them into a better home loan where they can qualify for the house they want.
Right, wonderful. So tell us, how can they qualify? What are the requirements for them to qualify?
Okay, the requirements for qualifying for a loan. We want you to have a job. So most people have had a job for at least 2 years. We do a lot of loans for college graduates. So if you're a college graduate and you're, for example, like an accounting degree, you show us that you've been going to school for the last 2, 3, 4 years. You show us a copy of your accounting degree, your diploma, and you just got an offer from an accounting firm to start working there for $100,000 a year. That's the income we're going to use. We just want to make sure that you do have one pay stub that they're going to pay you. Those are the things that we're looking for. You have to be employed, and you have to have a good credit score.
And the debt-to-income ratio?
And we use debt-to-income ratios. Thank you, Niveen. So debt-to-income ratios, what are debt to income ratios? That is going to, for example, to make it easy, let's say your gross, we use gross numbers all the time, your gross income is $10,000 a month. This is an example.
Right.
On a conventional loan, we'll go up to 50%, so that would be $5,000. The $5,000 would be your house payment, your taxes, and insurance. Also, we would include your your car payment and any minimum credit card payment. What happens is sometimes people forget if they have child support or alimony, we have to take a look at that too. Okay. So those are the things that we do. We add them up, and it can't be more than 50%. Under the FHA and the VA programs, we go up to 55% on a strong buyer. The state programs will hold you hard and fast to 45%. Now, on the state programs, I forgot to mention, there's two other programs where they will give you money, not as much, up to 5%. State charges 2%, so they only really give you 3%. Those loans can be forgiven when you stay in the home for at least 2 years. All right. The interest rates are a little bit higher on all 3 of those programs, the state and the 2 grant programs, because that's how they make their money. So on a regular loan, it could be anywhere from 1/2 to 3/8 higher on an interest rate.
And that was going to be my next question, is the interest rate. So thank you for
They're
covering
going to be
that.
higher on the down payment assistance programs. They will be higher.
Okay. Now, another question is, you were speaking right now about having a job, that you have to have a job. What about self-employed people?
Okay, good question. Self-employed people, we want you self-employed for at least 2 years. We're going to look at your tax returns, and we're going to take a look at those things. Self-employed people, a little bit harder because you think you make more, but you don't, because you're taking a lot of write-offs. We have a lot of different options. For self-employed people, right now we just put in 2 new programs. For people that, let's say, have been in business for a few years, they show they don't make a lot of money, but they really do. So we have 2 options. One, we do a bank statement program. They have to have a minimum of 700 FICO credit score. They have to have been in business for at least 2 years, and they have to put down 25%. However, we do a bank statement program with them. And the bank statement is, we look at 12 months of bank statements of their deposits from their business. So for example, if they're doing deposits of $50,000, $60,000, $70,000 a month that they're getting in for their business, and we average it out, we can give them up to $60,000 a month in income. So it really allows them to qualify for a lot more, but they don't want that because they want to have a payment they can live within. The second program we offer is a 1-year tax return. So 1-year tax return can work on a conventional loan and also on this program. Because if you've been in business for at least 10, 20 years, you know, as you know, most self-employed people, their income goes up and down. It goes up 1 year, down the next year. On a normal program like conventional and FHA, they average those years. So if you made 200,000 1 year and then you made 250, they're going to average it. Whereas if you made 200,000 1 year and you drop the next year to 150,000, they're going to use the lower of the 2. When we run it into the system, we may be able to get away with 1 year's tax return, Niveen. So we're going to look at the last year tax return. If it allows it, we'll take it and throw out the rest. Or we have a program, we'll look at the 1 year tax return, again, 700 FICO, 25% down, and 1 year's tax return, and self-employed for 2 years. A little tricky on that one because we're not going to look if you owe any money to the IRS. We're not going to look at a lot of different things. If you haven't filed your tax returns, we're not going to look at that either. But for unique buyers, and we can always get in detail with those people, have them give us a call and we'll go over those options with them because there are items for them.
So basically, if you are self-employed or if you have a job, definitely there are lots of options that for you that you can have. And Jerry, can you give our audience tell us, like, why do you need to be pre-approved and pre-qualified prior to buying the property? What is so important about that?
Niveen, that's the most important thing is, why do you want to be pre-qualified? You can't assume anything, by the way, in this job.
Of course.
There's so many different guidelines that are out there that we're aware of, that you, the consumer, are not, that we want to make sure we get ahead of. So when a client gets pre-approved, we look at all their tax returns, we look at their W-2s, We look at their pay stubs. We're looking to make sure there's no child support alimony. We're making sure that they don't know the IRS sending money. We want to make sure their debt to income ratios are in line. We look at those things because they want to tell us, we want to ask them really what price range you want to be in. Just because you can afford a $800,000 home doesn't mean you want the payment that comes along with that.
Right.
So those things we want to find out what exactly you can afford with the amount of money you have for the down payment. Are you getting gift money? How much money have you saved? How much money are you netting on the sale of your home? If you're going to use a state program, we have to take a look at all those variables. So that way, once you're pre-approved and it's going to be a $500,000 home, what we do, Niveen, as you know, we tell you, Niveen, John Doe is going to buy this house for $500,000. He's going to put $100,000 down, and he's going to be going with the conventional loan. So what happens is when you make your offer, Niveen is going to make your offer for that home for $500,000. We're going to show proof of funds that you have the $100,000.
Right.
Second of all, we're going to show that you've been qualified, so we're going to provide your credit score and a letter saying you're pre-approved. So now when your offer comes in from Niveen and I, they look at it and they say, well, this buyer has already been approved, talked to a lender, has showing us the proof of funds, and that they're qualified to buy the house. And then the other important factor is I'm going to call that real estate agent, that listing agent, and say, Niveen and I have buyer John Doe. John Doe is ready to go. We can close within 21 days. That is a lot stronger offer than you going in there, making an offer and not having been qualified, not showing any proof of funds, and not showing your credit score. That is why you want to be pre-approved as a buyer, so you know exactly what you're buying. And you want to look at homes that they're going to fit your needs.
That range.
Right. You don't want to. We know you don't want to waste your time looking at an $800,000 home when you really should be buying a $500,000, because we all know time is valuable for the realtor and for yourself, and you don't want to be looking at homes you can't afford. Or if you're looking at 250 when you should be looking at 400, you want to look at the homes that is going to be the best for your family.
And that's why the pre-approval letter gives us as agents the the guideline to go by. So basically, I would never be able to work unless Jerry gives me that pre-approval letter and tells me, okay, here is this for this client, and then I can go ahead and start looking. So this is wealth of information, Jerry. Thank you so much for providing all this information, and I truly appreciate being with us today.
Thank you. Anytime we're here to give you guys information on how to buy a home, give Niveen and Jerry a call. I'd be glad to help you. Have a great day.
Thank you so much, and until next time, see you soon. Bye for now.
Bye.
Thank you so much for watching. If you have any questions about lending, or if you would like to connect with Jerry, give me a call back at 909-631-5301. I'll be happy to connect you with him. Don't forget to like this video, share it with others, and subscribe to my channel. Until next time, see you soon. Bye for now.